Industry-specific financial ratios are specialized analytical measures designed to evaluate performance characteristics unique to particular industries or business models. While general financial ratios such as profitability, liquidity, and solvency measures apply broadly across companies, industry-specific ratios provide deeper insight into operational drivers and competitive conditions within individual sectors. The program explains that analysts must adapt ratio analysis to industry characteristics because business structures, capital intensity, regulation, and revenue generation differ significantly across sectors. Using inappropriate benchmark ratios may lead to misleading conclusions regarding financial performance and risk. Industry-specific analysis therefore improves comparability, forecasting accuracy, and investment decision-making by focusing on metrics most relevant to operational success within each industry. In the banking industry, analysts focus heavily on ratios related to asset quality, capital adequacy, and interest spread management. Common measures include the net interest margin, loan-to-deposit ratio, non-performing loan ratio, and Tier 1 capital ratio. Net interest margin evaluates profitability generated from lending activities relative to interest-bearing assets, while non-performing loan ratios assess credit quality and default risk. Capital adequacy ratios measure the bank's ability to absorb losses and maintain regulatory compliance. Because banks operate with high leverage and depend on confidence in financial stability, solvency and liquidity analysis are especially important. Analysts evaluate these ratios carefully to assess risk exposure, earnings sustainability, and the institution's resilience during changing economic and credit conditions. Retail and consumer-oriented industries rely heavily on operational efficiency and inventory management measures. Analysts frequently examine same-store sales growth, inventory turnover, gross margin percentages, and sales per square foot. Same-store sales growth measures revenue growth from existing store locations and provides insight into underlying consumer demand independent of expansion activities. Inventory turnover is particularly important because retailers must manage inventory efficiently to minimize carrying costs and avoid obsolescence. Gross margin analysis helps evaluate pricing power and cost control. The program emphasizes that industry-specific operational measures often provide earlier signals of improving or deteriorating performance than overall profitability measures alone, making them valuable tools for forecasting and competitive analysis. In manufacturing and industrial sectors, analysts emphasize efficiency, capacity utilization, and asset productivity. Common industry-specific measures include operating margin, fixed asset turnover, backlog levels, and order growth rates. Asset-intensive industries require significant investment in property, plant, and equipment, making capital efficiency especially important. Fixed asset turnover measures how effectively companies generate sales from long-term assets, while backlog growth may indicate future revenue potential. Analysts also evaluate operating leverage because manufacturing companies often have high fixed costs that can magnify profitability changes during economic cycles. Understanding industry-specific operational drivers helps analysts distinguish between temporary cyclical fluctuations and more permanent structural changes affecting long-term competitiveness and financial sustainability. Technology and telecommunications industries often require different analytical approaches because intangible assets, innovation, and customer growth drive value creation. Analysts commonly examine subscriber growth, average revenue per user, research and development intensity, customer acquisition costs, and recurring revenue percentages. High-growth technology firms may report lower short-term profitability because they prioritize expansion and innovation investment over immediate earnings generation. Traditional accounting measures may therefore understate the economic value of internally developed intangible assets and network effects. Analysts integrate industry-specific metrics with broader financial analysis to evaluate scalability, customer retention, competitive advantage, and long-term growth potential within rapidly evolving technological environments and highly competitive digital markets. Industry-specific financial ratio analysis is essential because no single set of ratios applies equally across all industries. Different sectors face unique operational challenges, regulatory requirements, capital structures, and competitive dynamics that influence financial performance and risk exposure. The program emphasizes that effective financial analysis requires combining general financial ratios with industry-specific measures to gain a complete understanding of business performance. Analysts must also consider economic conditions, industry cycles, technological disruption, and strategic positioning when interpreting ratio results. A strong understanding of industry-specific financial ratios enables analysts to make more accurate comparisons, identify emerging opportunities and risks, and improve investment, lending, and valuation decisions within specialized sectors of the global economy.